So we offer 7 different types of accounts.
Okay.
There's some business accounts. So if you have your own business, there are some business accounts that you can have. And the business accounts basically allow you to put more money into the IRA.
Okay.
So you have there's individual accounts. So the individual accounts are a traditional account or a Roth account. And so there's certain limits for each one. And then there's catch-up limits. If you're over 50, you can put a little bit more in. And that's
Right.
the IRS saying, here, you didn't save when you should have, so we'll let you
we
put
don't
a
want to
little
have to
more in.
take care of you too far down the road.
Yeah.
So, okay, go ahead. Okay.
So a traditional IRA is typically what we're used to. So let's say you make $100,000 and you put $5,000 in your IRA, you're going to be taxed on $95,000. So you get a tax deduction when you put it in the traditional IRA. Now, when this $5,000 grows to $50,000 and you pull it out, you're going to pay ordinary income tax at the time you pull it out. So that's a traditional IRA. Another account is called a Roth IRA, and this is also an individual account. And this is you make $100,000, you put $5,000 in your Roth, you're still going to be taxed on the $100,000. So you don't get the tax deduction going in. But when that $5,000 grows to $50,000,
Take it all.
You take it all tax free, never pay taxes on it. So one is paying taxes on the harvest, one is paying taxes on the seed. So those are the 2 individual accounts, and then we have the simples, the SEP, and the individual 401ks that we have. Those are commercial accounts or business accounts. Then we have 2 other accounts. One is I mentioned earlier, a Coverdell education account. So think of a 529 that you can
Coverdell.
Coverdell. Yeah.
Is that a what?
It's a Coverdell. It's a Senator Coverdell was the one who created the Coverdell.
How does that work?
So think of like a 529. You put money in for your kids. A CISA, Coverdell education account, is a self-directed IRA account for education. So its sole purpose is education. And so you can have one of those for your kids. There's a contribution limit, and those grow tax-free as long as you pull it out and use it for a covered education.
If the kid says, the heck with it, I'm going to be a rock and roll star, what do you get dinged then when you get that money out?
This is a great question because my oldest went to the military. So right now he's going to Cleveland State, and he's on the GI Bill. So his education account might not be used. Or at least maybe later. So I can roll it to his sister. I can roll it to a niece. I can roll it to if he has children. So you can roll it to some other people, or you can take it out and pay a little bit of a tax on it.
What branch is your son in?
He was a Marine.
Marine? Oh, no kidding.
Yeah.
That's the real thing.
Yeah, he's a good kid.
Yeah. You know, all those kids who want to get their college paid for?
Yes, absolutely.
They can do that.
And as we mentioned,
they can do that. They can just they can try.
And as we mentioned before, they have mineral rights monthly that are going to pay for their college from oil and gas.
Oh, that's amazing. That's really neat. Yeah. That's fantastic.
And then the last account that I want to talk about is a health savings account.
Okay.
Now we all know that in this country, especially our health expenses are going to increase as we age. So the interesting thing about this is it's like the Coverdell where it grows, but when you pull it out, it has to be for a specific purpose, and this has to be for healthcare. But that's pretty broad. You can use it for all kinds of things.
It's anything from healthcare in terms of paying for a prescription to whatever.
Prescriptions, therapy, all kinds of stuff. And if your doctor writes you a prescription, you could probably use it to buy a pool if you need pool for therapy. So it's pretty broad. And what I love about the HSA, and I think it's the most underutilized account out there, is just like we talked about the traditional and the Roth, you get a tax deduction going in on the traditional.
Yeah.
Same with the HSA, you get a tax deduction going in, and then it grows tax-free. So it's like the best of a traditional and a Roth combined. The caveat is it's only for health expenses.
Yeah.
And so what some of our clients are doing is, I have health expenses this year. Let's say I have $4,000 worth of copays or whatever.
Okay.
Instead of redeeming those or instead of submitting those to and taking a distribution on my HSA, I'm going to hold those. I might hold them for 5 years.
You can let that whenever. I say the same thing. It's like pretty much.
So I'm growing.
Just keep
my
your
HSA
receipts, so to speak.
Keep your receipts. I'm growing my HSA tax-free.
Yeah.
And I also can kind of titrate on, I only have $40,000 worth of expenses, so I better, So HSAs are a really great type of account that we offer.
Yeah.
Very broad. And we could do a whole half hour on HSAs, actually. They're pretty.
Do you want to do one on just an HSA?
Let's do it next time.
Okay. All right. That's what happens sometimes when we do these. It's like, oh man, that would be a great, that'd be a great idea. Write that down, and that's.
Yeah.
All right.